Hello, we are going to present the financial statements and balance sheets of the company Ecopetrol, highlighting ratios and their analysis.
Ecopetrol's interest coverage ratios show a strong ability to meet its financial obligations. The relationship between its operating earnings and interest expenses indicates that the company generates more than enough income to cover its interest payments or debt. Although these ratios simply decreased between 2022 and 2024, the values remain high. This shows that despite changes in its results on financial cost, the company maintains good financial health and a low risk of short-term insolvency. The leverage ratios indicate that Ecopetrol has balanced capital structure, but with a notable difference between its book and market values. The debt-to-equity ratio, around 1.09, suggests that the debt is almost equal to shareholder equity, which is a moderate level of leverage. However, the debt-to-equity ratio is much lower than 0.4, which shows that the market values the company's equity much higher than its book value. This difference is a positive sign as it suggests that investors see the company as less leveraged and with a lower risk of insolvency than the balance sheet might imply.
Profitability. Ecopetrol mainly saw profitability, although margins have been gradually declined since 2022. This trend goes higher operating costs and person on efficiency to which could affect long-term competitiveness. How, However, the company is generating po- positive returns, showing resilience in its operations. Liquidity ratio remain at healthy levels. 20 current and current ratio consistently able on this indicates that Ecopetrol is capable of covering its short-term obligation without major difficulties. The improvement in the cash ratio also shows that the company has enough cash to face immediate commitments. Working capital management is stable with inventory days or consistent efficiency across payable days remain standing, reflecting balance relation with suppliers. Our account receivable the increasing meaning customers are thinking lower to the pay this good credit person on cash flow in the trade continues.
Price settings by David E. In 2024, Ecopetrol's P/E ratio was 5.12, slightly above 4.98 in 23. This suggests the market is publishing the stock higher relative to earnings despite lower net income. A P/E below 10 remains low for the energy sector, point to possibility underpolity on but also reflecting risks from oil price, policy and geopolitical factors compared to the industry average age to 12. Ecopetrol shows potential as a below investment. Market to book aim debit B. The aim debit B ratio dropped to 0.70 in 2024 from 1.13 in 2023, showing the market below equity below book value. Will these signals concerns about assets quality or future probability the rise in book equity from 103 to 102 million units? Highlights a stronger balance sheet. Ratios under one often mean undervalued on but also market caution. Enterprise below two sales. AB divided sales. AB divided sales fell to 1.34 in 2024 from 1.45, reflecting lower sales 133.23 million cup versus 143.08 trillion, but also improved valuation related to reverse notes. With net debt rising moderately, this ratio remains below sector norms. 2 to 4 suggesting Ecopetrol is attractively priced but exposed to commodity and protection risks. Enterprise below to EBIT. EBIT divided EBIT at 4.64 in 2024 versus 4.99 in 2023. EBIT divided EBIT indicates solid operational efficiency despite EBIT decline. 38.46 trillion versus 40 on 1.65 trillion, well below industry standards 88 to 15. It reflects undervaluation, attractive for investors. Tone risks include debt increases and oil market volatility. And enterprise below to EBITDA. EBIT divided EBITDA. The ratio decreased to 3.32 in 2024 from 3.75, even with slightly lower EBITDA 53.66 trillion versus 55.46 trillion. This highlights efficient in cash generation and potential undervalued as it standards below industry average. 6 to 10. A strong cash flow supports defense and debt management, though capex for sustainability may pursue futures metrics. And conclusion, the five ratios analyzed show that in 2024 Ecopetrol trades at conservatively low multiples compared to sector average, segment potential undervaluation displayed declines in revenues and earnings. The company um, maintains a solid equity base, operational efficiency, and a strong cash flow generation, reflecting its appeal for below investors However, bit risks due to oil price volatility, rising debt, and the energy transition must be factored into long-term assessments.
Okay, access turnover shows how many pesos in sale age pesos invested in assets generates. In 2022, each peso in assets generates 0.52 in sales, while in 2024 it fell to 0.44, a decrease of 8 basis points compared to 2022. This reflects a decline in operating efficiency. Ecopetrol is generating less revenue per assets unit, possibly due to increased investments in assets that have not been fully monetized or due a lower sales momentum. ROE measures probability for shareholders. In 2022, Ecopetrol achieved a very high probability of 31.2%, driven by higher profits and relative lower equity. In 2023, ROE fell to 22.16%, a reduction of basis points reflecting lower net margins or equity growth increased that profit. In 2024, the decline continues to 30.58% on 17.44 percentage points less than in 2022. This is a strong sign of deteriorating in Ecopetrol ability to generate value for these shareholders. ROA measures the ability to generate the operating profits relative to total assets. In 2023, ROA was 5%, showing to acceptably return on assets. In 2024, it falls sharply to 1.7%, a decrease of the 3.3 percentage points, reflecting a sharp deterioration in asset efficiency. This implies that Ecopetrol assets had generate much less returns in 2024, possibly due to lower operating revenues, high costs, or increase in assets that are not yet producing returns. And ROIC assess how efficiently the company generates returns from total invested capital, equity, more net debit, and in 2024, the ROIC of the 12.8% and shows that for every invested in Ecopetrol capital, the company generates 22.8 of operating returns after taxes. This value is still higher than the ROA, 1.7%, indicate that financial leverage continue to play a positive role, but the level is still below what is expected in an oil company that typically seeks ROIC 55%. Ecopetrol DuPont analysis shows that the deterioration in ROE between 2022 14.7% and 2024 17.8% in mainly due to the sharp drop in the net margin um, from 22.3% to 11.2% and lower assets turnover from 0.52 to 0.44, which reflects lower operating efficiency and a lower ability to convert assets into sales. Financial leverage equity multiplier close to 3.6, remaining stable, so it does not explain the reduction in profitability. In conclusion, a lower profit generation and efficiency in the use of assets are the factors that have significantly reduced shareholders' returns over the last 2 years, despite the company remaining constantly leveraged.